Good day, fellow investors. JPMorgan is out with their new quarterly guide to markets that gives a great overview of what's going on in the markets, the valuations, the opportunities across investment sectors, the economy, the deficits that translates into the money situation, and then I'll just quickly finish with the pension issues that might arise over the next decade. Great charts by JPMorgan. So let's start, and if you enjoy this, just click that like button to support the channel. Thank you. Let's start with valuations. The S&P 500 is at pretty high valuations, similar to the dot-com bubble. So we can say there is a lot of exuberance, but this is just the S&P 500, and we'll see later how it's not all about the S&P 500 when it comes to investing. High valuations, of course, lead to lower expected returns. 5 years annualized returns, total returns with dividends are on average zero when it comes to such high valuations. The lower the valuations, the higher the returns, because investing is, after all, about fundamentals. Short term, anything can happen, but again, the trend is clear: the relation between valuations and returns. However, earnings are still growing, which is good, and we might not see a crash, but it might take a few years for earnings to catch up with valuations. Currently, earnings are hit by lower margins because of the COVID crisis, but if things rebound, as it has been the case in history, then we might see improved earnings, and that is also what the analysts expect. Talking more about valuations, the high valuations are really skewed into the top stocks, the top S&P 500 stocks, and the rest of the market isn't that exuberant. And we'll see later, if we talk at Europe and emerging markets, it's even less exuberant. If we look at the distribution of valuations, it's a very wide range currently, similarly to what was the case in 1999-2000s. So very exuberant times and exuberant valuations. Hot stocks have very high valuations, unlike stocks have normal valuations. And this tells me that no matter where, no matter what, you can always find businesses that offer good returns. This is what? 8-9%, 7-9%. That's good. That's not bad, and that is what makes you rich long term. You just have to look for that. And then, speaking of value versus growth, I don't really like that comparison, because something can look valuable from a financial metric perspective, but if it goes bankrupt, then the real value is zero, even if the accounting book value and low price earnings ratio tells it's a great buy. For example, oil companies have great metrics now, but we don't know about their long-term sustainability, at least not all of them. But on those metrics, again, we can see how value is cheaper and cheaper, as it was the case in 1999. Of course, it can get much cheaper than it is now, but it's a good thing to know looking forward. And then again, on the divergence of the S&P 500, you can see how the market is now totally focused on COVID stocks, so retail, online, information technology, home improvement, groceries, and retail, airlines, energy, hotels, everything that's not COVID is thrown out. And perhaps there are here some babies that are thrown out with the bathwater. And this is a very, very beautiful chart. Factor performance. All these factors, and all of them vary around time. So you see momentum, but at some points in time, momentum did really badly. Sometimes cyclicals do very bad, sometimes cyclicals do very good. Value can do good, value can do really bad. So you never know what will be the best driver of returns. Small caps bad, small caps really bad, small caps really good. And when it comes to investing, we always have to find what works best for us, no matter the factor involved. Or we can look for unloved factors and then see whether there is something for us there. Speaking of value, the United States make 57% of the total global stock market capitalization. That's really, really crazy, on 20% of GDP. But that's the market, that's the world we are living in, and looking at JPMorgan's charts, I would argue that perhaps it's better to look elsewhere for investments. Not that the US market will do badly, could do great, will probably do great. I'm just looking that perhaps there might be a bigger margin of safety within sectors that haven't rebounded but have good fundamentals. As always, it's about risk and reward. If we look at earnings in emerging markets grew. This is the tax benefit in the US, equally to the United States. So there is growth, a little bit less growth in Europe, but the valuations are much lower and the price to book is not 3 point something as it is for the S&P 500, but much lower. As you can see here, compared to the S&P 500, emerging markets have much lower valuations, which means those are undervalued. And 2021, I'm sure we'll be looking a lot at other opportunities for low risk, good reward investments out there, because over the long term it's always about managing risk first and then the returns come by themselves. So if you're interested in alternatives, subscribe to this channel and also check what I do in the links in the description below. There is my stock market research platform where you can find many analyses on stocks that are not really mainstream but can be really good long-term investments. Talking about risks, if we compare developed markets with other markets, the things get more interesting. If we look at US debt to GDP ratios, those are skyrocketing. Also, corporate debt is skyrocketing. Plus, fiscal spending, the governments really in the developed world spend a lot of their GDP to help with the stimulus to keep things as stable as those can be, but other markets didn't spend that much, which means that long term these markets might be more sustainable than this one, because there is no free lunch in economics. Fiscal deficits are expected to be even bigger, 5.3% per year over the next decade. This 10-20 years ago would be a crazy situation, but now those are different times. However, this will likely lead to money losing value, currency debasement, and that's also something very important when it comes to investing. On the other hand, China, also a lot of fiscal stimulus, but still growing pretty strong. While the global economic growth, okay, 3%, expected to be much better in the coming years. However, long-term drivers of economic growth, especially working age population in the developed markets, is very low compared to earlier years. Also, productivity is down, and we'll see how will this look like in the next decade. It already looks ugly from a fundamental perspective, and these JPMorgan charts really emphasize that. Depends on what you look at. Nobody is focused on these things now, but over the coming years, this will likely be the focus. Stay tuned. 68% of GDP comes from consumption, which is crazy, unsustainable if you base it on debt. Compared to demographics in emerging markets, the Indian middle-class population is expected to explode over the next decade. Indonesia, still China, Brazil growth, Mexico, huge growth ahead. And that's a trend I like to be exposed to. I'm looking now at opportunities. Always commodities are still an opportunity over the next decade, even if it already happened, the boom happened already there in copper and other commodities that we did well on. However, we'll see over time will follow, and look always at risk and reward. What I also spoke in the cash video, with money, inflation, this is the Fed's balance sheet, printing at will. This is the expectations, more printing, more purchasing bonds by the Fed, ECB increasing bond purchases, Bank of Japan, Bank of England, and inflation going higher. The required 3-year average inflation rate would be 2.38% to get to a normal Fed average target. So 2.3% inflation with interest rates at 0, which means that, okay, something is wrong here, and at a certain point in time they will lose control of inflation. Or they won't lose control, but it will be 3-4%. And that could be changing, shifting the paradigms that are prevailing in the current investing environment. Inflation has been low, which allows the printing, but this might change as it was the case in the 70s. And you can see when it changes, it doesn't have mercy, it explodes very, very fast, and it's very hard to manage. It took, what is this, a decade to manage in the United States. And then something very interesting on pensions. If we look at the defined benefit plans, now they changed them to non-defined, so they save themselves, but look at this. 100 companies, there is not enough assets to cover for the liabilities. You see, and this is very important because these assets to cover for the liabilities are calculated on the following pension assumptions. And these guys from JPMorgan are very smart to include this in. If we look at S&P 500 companies, those had assumptions of 10% returns, and now they lower those assumptions that are baked into the asset values to 6.5%. State and local pension funds still think they can make 7.5% per year. With interest rates at 0, you tell me, how are they going to make 8% per year? And if they don't make 8% per year, these discrepancies here might be even bigger, might lead companies to bankruptcies, and we have seen that with the Alcoa video. When the stock went down, when the values of the assets went down, the company almost went bankrupt because of the pension obligations. And this is another issue that will be discussed over the years. We'll follow it, and we'll update again when the next quarterly market overview from JPMorgan comes out. I hope you enjoyed this, looking forward to your comments, click that like button, and I'll see you in the next video.